today's trading range, back in the green for Nifty. Good time to get in Raunak. Onkar, the co-fund manager of equity and head of research at PPFAS Mutual Fund. Raunak, always a pleasure speaking with you. The market's been moving higher. It's very interesting because the kind of frenzy that there is in, people chasing ideas, themes. What do you think? What do you make of what is priced in already, and whether there would be any sort of, expectation of fulfillment of those prices?
So interesting phrasing, Mangalam. Expectations are at a fever pitch. I don't think there is enough earnings growth that can materialize to meet all the expectations in all the sectors. But this is a feature of the market. It happens at times when people get overexcited about various sectors and various themes, and they keep discounting the future growth into the near term. And that's when you have to be more careful in terms of not chasing that narrative. And you have to evaluate every situation independently and see whether the growth expectations can be met, or even whether that is the kind of valuation that the business or the sector deserves from a cyclical point of view also.
Hi Raunak, good afternoon and good to see you, Ben. Just to confirm, your cash positions, I think they were at around 15%. It continues to hold around there?
Hi, good afternoon. The cash positions are around 16%. They haven't moved materially, but we have accumulated a bit of cash.
But you'll have?
We have a bit of cash, which is more than what it was last.
All right, little higher. Got it. Raunak, suddenly the regulators turn its attention to the markets. Various soundbites are coming that maybe it's time to be quite rational. Don't get too excited with regard to the party. If that is the case, I'm just looking at some of your, what you'll have in your portfolio. It seems some of these stock market plays, you'll have been reducing some stake. If I look at UTI, AMC, Motilal Oswal as well. Tell us more about that.
So with capital market related entities, the intermediaries like stockbrokers, AMCs, they have tremendous operating leverage if you see the business model. When the market goes up, the volumes go up, and the earnings profile of the business also looks dramatically different from a normal market or even a bear market. So you will see them cyclically high in terms of their cash flow generation, their profit generation. And at that point in time, if there can be a reversal in that trend, then you will see the operating leverage working against them. And you will see that the cost will not grow dramatically, but at the same time, the revenue and the profits can fall quite dramatically. So it's better to be cautious when you're looking at cyclicals which are dependent in capital markets, will depend on the valuations of the market. And that's the reason we have been reducing them. They still hold a little bit of position in the portfolio, but we have not completely sold out.
Okay, got it. Just one more thing, there are a few companies though that you'll have gone and added some position. ITC, I recall we had discussed it long time ago. You'll were very early in there, but it seems you'll have come back to the addition phase, because on ITC you'll have added positions over there. And the other one that I've seen, on a month-to-month basis, there is a sizable addition is IGL. Both those two, the CGD companies. So tell us more on that front.
From ITC's point of view, the business model remains the same. It is just a valuation that it became a little bit more reasonable for us to add, and we thought it's a good time to a little bit add since we also have cash. And it's been performing well. The numbers speak for themselves. And in terms of IGL, if you look at the overall adoption of the gas as a source of transportation or even piped natural gas at home, it's been a trend which has been growing for a long period of time. And despite the fact that we are looking at EVs coming in, we are looking at commercial vehicles going towards battery-operated vehicles, it might be a trend which will be slow to be adopted rather than going to happen next year or the next 5 years. It's going to be a long-drawn trend. And meanwhile, you will need alternate fuel sources, the traditional fossil fuel sources. So within that, it seemed reasonable to own a company like IGL, which is a good distribution network in Delhi.
Raunak, hi, great to have you on the show. Coincident, just a couple of hours back, I was reading Neil's tweets and then I realized you're coming on the show. So I think it's perfect timing, right? I think those tweets have caused a fair amount of flutter on Twitter, on X. We'll put them up in just a bit. For the benefit of viewers, I just want to, read this out. Neil Parekh, who's of course, the big boss, the head of PPFAS, has just said, wow, the sheer number of NFOs launched, especially thematic funds, is a bit scary. Be careful, guys. Context, yesterday's inflow of 40,000 crores plus saw over 20,000 crores come in from thematic funds, sectoral funds, and a lot of it is NFOs, because that's the only place where mutual fund houses can innovate and launch new products. Everything else is watertight. Neil then goes on to say, we're staying away from excesses, are mindful of starting valuations, and also have some cash. We're happy to underperform in such markets. Not a bad time to slowly redeem if you need money in the next couple of years. So that's a big statement to make, right? And from the head of an AMC, but maybe from his perspective, he can make that statement. How difficult is it for you to execute it? I mean, underperformance, not deploying 16% cash, starting to sell off these high flyers like the capital market related places. Give us, your construct, your thought process around this, and throw in a word on some of these areas like, CapEx, PSUs, defense, etc. as well.
So underperformance is a guarantee. It is not something where you can get away by underperformance. And at different points in time, different styles of investing work. What we have been choosing is more of a value-oriented approach where we will not chase valuations. We will go where the valuations are reasonable and sensible. And if we don't find them to be sensible, we are happy to stay in cash. And as a result of that, we'll underperform temporarily when the market froth is there. So Neil is absolutely right. They're all in sync about this. And we try to caution our investors not to get too carried away with narratives. Even though they might be good themes or the good sectors to invest in, it's also important to get the entry valuation right. You cannot just chase any story without having any substance behind it. So yeah, from that point of view, the valuations, the portfolio allocation remains the same. You mentioned about PSUs, you mentioned about the power infrastructure companies. All these companies are part of the portfolio because the valuations are reasonable. Despite some companies in that sector have seen stratospheric valuations, these companies have not seen that. And these are more reasonably priced, dividend-generating, cash flow-generating companies, which don't change dramatically overnight. So we might miss a few great opportunities to invest, which is fine, as long as we keep the money safe.
All right, which is what brings us back to where we started. Which parts of the market where you think, the valuations have run up much ahead of the earnings that you believe that they can deliver? And what still seems reasonable if you had to, allocate fresh 84 rupees of the 100 that you're getting right now, because 16 you're holding in cash.
And also, if I could just add to that, Raunak, also what else are you taking profits from apart from capital markets, where you're thinking the party is over, it's time to get out? So tell us both, where you'll deploy, what you'll buy, and where you'll exit.
So Mangalam's second question is easier to answer because we have been adding some of the IT services companies and banks, private sector banks that we own. Wherever valuations are reasonable, we are adding and topping up the existing positions. Nothing new has been added and nothing new has been sold. So we have been only selling the capital market related entities because bulk of the portfolio, even though the prices have gone up, the earnings have also caught up and the valuations are not extreme. So yeah, we constantly keep a look at the valuation. That's our job. And we make sure that we only trim when the valuations look really frothy and unsustainable from a growth point of view.
All right, and I think the two banks that you were, loading up on was HDFC Bank and Kotak Mahindra Bank, right?
Yes.
And HDFC Bank, it appeared that it's getting ready to fly away, but then suddenly it's pulled back a little bit. I think the stock doesn't like too much of excitement. It's down 10% in the last 1 week or so. But we appreciate you joining in, Raunak. Rational thoughts coming in as always. You have upped your positions in ITC, as well as in IGL and Maruti, taken some profits off the table in capital market plays like Motilal Oswal as well as UTI AMC. And you continue to select ITES as well as private banks. Thanks a lot for joining in and filling us in with that quick take. For the time being, though, we'll slip into a short break with news that the Nifty is back in the